Welcome to Books in Sum, your go-to for bite-sized book summaries.
Goals-Based Investing by Tony Davidow. Financial advisors' success will be hindered if they do not recognize the ways in which the financial services industry has evolved over the past few decades in order to better serve investors. This blink explores the evolution of the wealth management sector, as well as its present state and potential future, from the perspective of an investor. Wealth management companies, custodians, and asset management companies all lend a hand to financial advisors in today's ever-changing financial services industry. It's safe to assume that the financial industry will undergo even more transformation in the next decade than it has in the previous 2 decades. The first index fund was established in 1975 by Jack Bogle, founder of the Vanguard Group. With over $6 trillion in assets, Vanguard is the world's second-largest asset manager. Investors questioned the value of using professional investment managers after the 2008 financial crisis, leading many to turn to DIY strategies instead. After the financial crisis, both investors and their advisors started making greater use of ETFs. Investors were helpless as their fortunes declined after the pandemic hit the financial markets. There has been a need for wealth management firms to evolve over time so that they can meet the changing needs of their clientele. Because modern portfolio theory incorrectly assumes that all investors are risk-averse, goals-based investing is a remedy for the fact that not all investors choose the optimal, less risky option. Post-MPT was developed in 1991 and offers a new way of thinking about the relationship between risk and expected returns. As of 1992, the Black-Litterman version was available. While both the Black-Litterman model and post-MPT have their flaws, goals-based investing moves the focus to the investor's desired outcomes. It tries to strike a good balance between risk and return in order to accomplish its goals. Financial experts and investors alike must be conscious of the role that cognitive biases play in their decision-making processes. The cognitive biases of loss aversion, illusion of control, recency bias, and herd mentality can all have an effect on financial investments. Advisors should acknowledge that they, too, are susceptible to these biases, encourage clients to stay focused on their long-term goals, and caution them against making hasty decisions based on impulse or emotion. Having an investment policy statement that gives advisors the authority to act on their clients' behalf without seeking prior approval can be helpful. Advisors can better communicate with their clients when they use a story or analogy to illustrate a point. When explaining asset allocation to clients, Davidow compares the process to that of making an omelet. If they want to be taken seriously as professionals, financial advisors should also educate their clients on the principles of behavioral finance. In 1973, Burton Malkiel made the audacious claim that a portfolio chosen by a blindfolded monkey throwing darts at a newspaper's financial pages would perform as well as one carefully selected by experts. The first index fund was introduced by Vanguard in 1975, and the first ETF was introduced by State Street Global Advisors in 1992. Because of ETFs, investors can gain low-cost and tax-efficient exposure to the market. The total assets managed by the over 2,200 exchange-traded funds in the United States are now over $6 trillion. While exchange-traded funds originally emerged as low-cost, high-efficiency passive investment options, they have since expanded to include a variety of sophisticated options that employ alternative weighting strategies like value, size, quantity, volatility, and momentum. While ETFs do provide advisors with more options when constructing client portfolios, active management is still necessary. ETFs, mutual funds, and SMAs are being used as building blocks in new asset allocation models being developed by large wealth management firms. However, some high net worth and ultra-high net worth families still require individualized portfolios to meet their unique needs. So-called alternative investments, which aim to reduce risk by diversifying income streams, have become increasingly popular in recent years. The market environment, the impact of the COVID-19 pandemic, assets with negative yields, rising inflation, and growing tension around the world are 3 main factors to consider when looking at alternative investments. Managers can now provide investors with access to alternative strategies that were previously unavailable due to high entry barriers thanks to product innovation. Privately offered funds now have a more level playing field in terms of advertising thanks to the Jobs Act. In 1949, Alfred Jones created the first hedge fund, which invested equally in long and short stocks and had a cap of 99 investors. The partnership structure and the practice of rewarding the fund manager with a share of the profits are 2 aspects of Jones's original model that have survived into modern hedge funds. Investment opportunities across the spectrum of private equity, private credit, and real assets are now accessible to a wider range of investors. Before putting money into private equity, advisors and investors should be aware of the process and potential pitfalls associated with each stage. Questions like, what role do private markets play in a client portfolio, can only be answered with the help of a wealth advisor. How do we decide which path to take? The expansion of sustainable investing is the primary focus of this article. Sustainable, socially responsible, and impact investing are all subsets of this larger field. By 2020, sustainable investing will account for nearly 1/3 of all professional assets under management in the United States, having grown from $12 trillion in 2018 to $17.1 trillion. To implement a goals-based investment strategy, one must first determine the specific outcomes they seek from their investments, such as retirement income, a college fund for their children, charitable donations, wealth accumulation, and so on. To begin, you must determine your investment goals, such as providing for your retirement, saving for your children's education, helping the less fortunate, amassing wealth, and so on. The steps involved in a goals-based investment strategy for a high-net-worth family client are the most important information presented in this text. Identifying and analyzing estate and trust issues, determining asset allocations, choosing the appropriate investments, keeping tabs on progress toward goals, and conducting consistent evaluations are all essential first steps. There should be 3 categories for the assets in a portfolio: growth, income, and protection. It is helpful to classify investments as either growth, income, or defense when explaining them to clients. If a wealthy family doesn't already have one, it's important to suggest that they create one as part of your initial interaction with them. Successful wealth advisors will need to adapt to the changes that will occur over the next decade. Davidow predicts that the typical investor will be a younger, more diverse person, and that goal-based investing will become the standard. McKinsey & Company agrees with him, projecting that 80% of advisors will provide goal-based investment advice by 2030. Education, commissions, and AI are 3 trends that could influence the business world in the next decade. Wealth advisors can set themselves apart from the competition by investing in their education. Commissions will continue to decline, and AI will gain a deeper understanding of their clients' wants and needs. The wealth advisors who do the best job of navigating and adapting to these shifts will be the ones who provide the most value to their clients.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries, and feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in, and happy listening.